This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome back to Bank Nerd Corner, the podcast for your bank nerd topics. My name is Alex Johnson, and I am joined, as always, by the delightful banking and fintech editor at Bank Director, my friend and queen of the bank nerds, Kiah Haslett. Kiah, how are you?
Good. How are you, Alex?
I am doing great. We still don't have any cicadas that are bothering us here in Montana.
Great.
The weather is good.
How is the trampoline?
The trampoline is going great.
Is the hit of the summer?
Well, yeah, I mean, I feel like I've won so far this summer because the trampoline's been all good. There have been no injuries. They don't even really, my kids don't cry or get into any fights on the trampoline. Like, it's
not a cage match or cage fighting.
It really hasn't been. And honestly, my daughter, who just turned 1, is really holding her own with her much bigger brothers. So
wow.
I feel like she's like getting good practice at what it's like to have big brothers and to have to kind of stand up for yourself. So it's all been good. How are you doing?
I'm good. It's been a busy travel in June.
Right.
And it's summer soccer season. So I'm outside a lot during like heat waves and brain meltingly hot. So, I'm just kind of holding my own, just a normal summer for me.
Okay, holding the line.
So looking for friends with a pool. I'm always looking to add some useful friends to my acquaintance. And I really feel the lack of pool friends right now.
Well, I understand that. I can't do anything for you there, but we are delighted to welcome a additional bank nerd friend to the podcast. Kiah, would you do the honors?
Yeah, so this is not a friend with a pool, but is a friend who published his papers and will interact with us on Twitter. I'd like to welcome Todd Phillips, who is an assistant professor at the Robinson College of Business at Georgia State University. Hi, Todd.
Hey, Kiah. Hey, Alex. Thanks for having me. And yeah, sorry, no pool. I wish I could help you out there.
I mean, if you're in Georgia, this is a need that's probably felt more strongly by you than me. I mean, I've heard nothing but that Georgia is hot in the summer.
Heat wave hitting the entire East Coast. Yeah, it's no bueno.
It's beautiful 72-degree weather here in Montana. Not to
rub it in,
but I don't get that many opportunities because it's winter 10 months of the year. So most of the time I'm on the losing end of this, but I will rub it in. Todd, we are delighted to have you join us. We are going to tailor today's Bank Nerd Corner episode specifically to your areas of expertise and some of the research and papers that you've published. So slightly different episode. I will mention that we are recording this one well in advance of when it's coming out. We're recording on June 20th. So some of the topics that we're talking about, I think, are timeless and will age very well. But Todd, there is one that we wanted to start with that our takes on this might age poorly just based on things that may change between now and then. But I think the last time Kiah and I recorded this, we were talking a little bit about the FDIC and some of the challenges that the, I guess at the moment, current chair of the FDIC has been navigating. I don't think it had been announced at the time that he had decided to step down, but we now know who is going to be nominated to replace Chair Grunberg as the leader of the FDIC, Christy Goldsmith Romero. And Todd, I'm just going to put this question very simply. Who is Christy Goldsmith Romero?
Sure. Christy Goldsmith Romero is a fantastic person. I love her so much. She is currently a commissioner at the Commodity Futures Trading Commission, which, yes, is not a bank regulator, but one thing many people don't know is most of the swaps dealers in the country that are regulated are banks. And so what the CFTC does on derivatives does impact all of those bank swap dealers. So I know there are some folks saying that she does not have banking experience. I would reject that, just given her time at the CFTC. I'm also hearing some folks saying that she doesn't have management experience, which is much needed at the FDIC right now. And she was the former Special Inspector General for the TARP program, SIG-TARP. And she managed a whole array of investigators and attorneys that were looking into the malfeasance of those banks that took TARP money. And she was one of the only, if not the only, person in the federal government who actually sent bankers to prison for financial crisis malfeasance. So I think Commissioner Goldsmith Romero is a great choice. I hope she does get confirmed by the Senate. But as you said, it's June 20th. And by the time this is released, maybe everything I've just said will, not be accurate. We'll have to wait and see. That's just my very short take.
Well, it's funny because I think sometimes we joke that banking is kind of commoditized. And so when a financial regulator who deals with kind of some of the commodity futures, which is not exactly commodities, she's not like the grain or the corn person, but some of the contracts that underpin some of that. Todd, can you briefly explain what the CFTC does, or what the swap dealer is for fintech listeners?
Sure. So derivatives are financial instruments that are based on the price of a different underlying asset. So a corn future could be a contract that says that the seller will be selling to the buyer a bushel of corn 10 months in the future at a certain price. That's a derivative. And what swaps dealers are, or just derivatives dealers, are financial institutions that help fund those transactions. So if a farmer needs to borrow money, or a General Mills needs to borrow money for the purchase of that grain 10 months in the future, banks are the institutions that fund those derivatives.
Well, that is super helpful, Todd. That's way more than I knew, both about the CFTC as well as Commissioner Goldsmith Romero. Not that it matters at all, because no one cares what I think, but you have convinced me to give my endorsement to Christy Goldsmith Romero. So thank you so much. We'll hope that she makes it through the process of actually becoming the chair of the FDIC. And like you said, things may change significantly. Let's jump to a topic that I think is going to honestly be timeless. And as we were joking about before we started recording, strangely became more timely and resonant between when you first started writing about it and now then we're recording. Kiah, why don't you introduce this topic and the paper that Todd wrote about this?
Yeah. So Todd, I don't think I've ever told you my take on this paper, but you recently published a paper called Stabilizing Shadow Banks. You had, and I noticed that you changed the headline from stabilizing fake banks to shadow banks or consumer shadow banks. Shadow banking is generally I know it sounds kind of cool and mysterious. It's generally a term that describes financial activity that is conducted by institutions that don't hold bank charters and are not regulated by bank regulators. And so we've talked about shadow banking in the past, and as far as private equity or hedge funds or these companies that provide funding and they make loans but don't use insured deposits, which is one of the things that makes a bank a bank. Your paper was about other types of institutions that engage in the activities that banks tend to do that make a bank a bank. And your paper starts with, one of the first sentences is there's no risk-free way to conduct bank-like activities, whether accepting deposits, providing payment services, or holding customer funds. As a result, customer funds are at risk when left with any firm that engages in these activities. So my first question for you is, how did you define a consumer shadow bank when you were writing, working on this paper? What do they look like and what do they do? And how are they not banks? Because that comes up so many times with is Starbucks a bank, right? Is Starbucks engaging in some of these consumer shadow banking activities?
So let's start off by defining what a shadow bank is, or actually what a bank is. So banks are financial institutions that take consumer deposits. A deposit is where the institution is borrowing cash from the depositor, and with that cash, they use it to make loans to borrowers. This process, where a bank will take demand deposits that they have to give back to the depositor whenever they ask for it, and use that to make longer-term loans, is called maturity transformation.
Right.
That's the difference between, deposits that are redeemable on demand versus a 30-year mortgage. That transformation of the immediacy to the 30-year timeline is called maturity transformation. Okay, so shadow banks then are financial institutions that do this type of maturity transformation, but are not banks. And there are a whole host of shadow banks out there. The big broker-dealers before the financial crisis were considered shadow banks. Money market mutual funds are considered shadow banks. And what my co-author, Matt Bruckner, and I did with this paper is we identified consumer shadow banks, which are financial institutions that do this kind of maturity transformation, but serve a consumer base. And so we have identified really 4 different types of financial institutions that do that. We have identified money transmitters like PayPal, Venmo, MoneyGram. We have identified stablecoin issuers, where these companies like Tether and Circle will issue, $1 stablecoins based on the assets that they collect, which they then use to make loans. And we also have identified imitation banks and crypto banks. Imitation banks are these financial institutions that have websites that look like banking websites and have a tendency to confuse consumers as to whether they are real banks or not. Crypto banks are basically all of the crypto lenders that failed in 2022. What they were doing is they were taking depositors' crypto, saying you could get it back on demand, but then we're turning around and making longer-term loans to crypto hedge funds like Three Arrows Capital.
Right.
And then when Three Arrows and others went down, the depositors started demanding their crypto back, and the shadow banks failed because they couldn't. That's just maturity transformation.
They had like a run, essentially.
Yeah, they ran. They ran, exactly.
Yeah. And it's interesting because like in the like kind of dumb derivative conversation around what is a bank and a Starbucks bank, I always kind of am like, hey, you know what? Starbucks is never going to give you your $10 back.
Yeah.
They will only give you coffee. And I think in some regards, people kind of forget that, a store of value, many companies engage in store of value and use those like quote unquote deposited funds to float their own operations. But the thing the reason why Starbucks isn't a bank is you can't get your money out. It's a one-way flow. The only thing you get out of that is coffee. So like, if you can't fully get the refund or the refund can't come in the form of the item that you put in, it's probably not a bank.
Yeah.
But it's interesting that people kind of, what do people see as a bank, or how do people understand banks? And it's really that like money in, money out for the same amount. And I think for banks, it's like also the money's insured. So that's like kind of what really is very special about banking.
The other part to it that I think is really interesting, Todd, is that maturity transformation can look different depending on the business model,
yes.
Right? Is I think one of the points that your paper makes. And so like the classic maturity transformation is, as you described, like take demand deposit accounts in and make mortgage loans that are 30 years on the back end. And that's like your kind of classic example. But your point is, as long as on the front end, to Kiah's point, there's deposits coming in, deposits, meaning like money coming in that's returned in the same form that it's deposited on demand, and then some activity that's leveraging those funds to generate a return, that is some form of maturity transformation, right? And so like, I guess crypto would be one good example where these kind of crypto banks weren't necessarily making loans to consumers, but they were loaning money to crypto hedge funds that were going out and doing trades, and they were using that return that they were getting from those borrowers to fund yield that they were giving to depositors, and then presumably to take some of that money themselves. So I guess maturity transformation can be a lot broader, is one of the points you make with shadow bank.
For sure. And, the point about there's no risk-free way to do any of these things. Even if you are borrowing customer deposits to buy a 90-day bond from either the Treasury Department or a private company or something, that difference between 90 days and immediate demand is still maturity transformation. We're not as concerned about that type of thing because Treasury bonds have high liquidity and we're not too concerned there. But yeah, anytime that you take customers' money and make loans or buy a financial asset or something with it, there's risk there. There's always going to be risk there. As we saw with the stablecoin issuers, so Circle had $3 billion of customer assets in Silicon Valley Bank. They were going around saying this is fine because the bank is regulated, it's not going to go down. But of course, the bank was using that money to fund its own loans. And then when it did end up going down, Circle, like all of the other depositors, could not get their money out. They would have lost customer funds had the FDIC not come in and triggered the systemic risk exception to make Circle and all of the other depositors whole. So yeah, even Circle, a stablecoin issuer, saying your money is fine because it's in an FDIC insured bank was not actually fine. It was not actually
They need
safe.
a narrow bank charter.
Yes.
They need to get that Fed charter instead of master account charter. Well, okay. So we've talked about that. Yeah. Well, let me keep going.
Yeah.
So we've talked about consumer non-banks. Your paper argues that, I think it explores kind of the regulatory and supervision environments, but makes the point that the CFPB, which is the Consumer Financial Protection Bureau, could have the authority to regulate these institutions, and kind of lays out by what authority. And your paper argues that a lot of this activity would fall under the definition of the CFPB's definition, not your definition, of abusive, and I think if people looked at that definition, they might kind of be surprised about what would constitute abusive behavior. And that one of the risks to consumers is they do not know this is happening. And so my question for you is, do we know what non-bank companies the CFPB regulates? We do know for banks that if you're over 10 billion, the CFPB does have supervision authority, and these institutions could get visits. We don't know sometimes the cadence of these visits, but do you have a sense of what institutions the CFPB has oversight of that would kind of flesh out your theory?
Yeah. So all of the types of firms that we identify in the paper, the money transmitters, stablecoin issuers, crypto banks, we think that the CFPB has authority over them already. It just needs to use them. The CFPB has clearly used its authority over P2P payment platforms like PayPal, and we're saying they should go a step further and use their abusiveness authority to address less than well-regulated maturity transformation in these institutions. The Dodd-Frank Act's definition of abusive is that a consumer financial act or practice has to pose material risks. Consumers have to not understand those risks, and the institutions need to take unreasonable advantage of them. And we think that this applies precisely here because, as we've talked about, maturity transformation is by definition risky. We also know that consumers have no clue that this stuff is happening. When the crypto banks failed, we looked at the letters that customers wrote to bankruptcy judges saying, I had no idea this could happen. They told me my money was safe and it wasn't. So consumers don't understand this. And we think that there's unreasonable advantage being taken here because it would be perfectly permissible for PayPal to basically take the money that customers are trying to send and do a debit from one customer's bank account and automatically do a credit to the recipient's bank account rather than keeping the cash on its own balance sheet. But it's not doing that. So there are ways to go about doing this.
Like it could automatically disperse. All funds could disperse.
Yeah.
Right. There'd be no PayPal balance, right? It could just move the money.
Exactly. But the fact of the matter is that PayPal makes a profit on the float. And so unless regulators step in, they're going to keep doing that and they are going to keep their customers' money at risk. We think this is abusive, and we say that the CFPB needs to step in and impose regulations to lay out the safe way to do these types of money transmission, deposit taking activities of consumer shadow banks.
So one of the things that struck me during the crypto mania, and again, we've sort of gone through multiple periods of these different types of consumer shadow banks kind of rising and falling, but when all of the sort of crypto banks were really surging and getting a lot of interest from mainstream consumers, again, who probably didn't understand a lot of this stuff, one of the things that grabbed my attention was the language that these crypto companies used to describe their products, right? And this is what kind of put them on my radar from a unfair, deceptive, abusive practices front. The language they were using had nothing to do with investments, right? It wasn't framed as an investment. It wasn't framed as a risk. It was framed as here is a yield that you can generate on your crypto. And we're going to compare this yield on our website to the average yield generated by a savings account offered by a national bank. And like, as soon as I saw that on these websites, immediately my mind went to a totally different place. But it ties in, I think, to your paper and the argument you're making, which is they are taking unreasonable advantage. And not only do consumers not understand this, but they are using language that I think you can make a pretty strong case sort of intentionally causes consumers to assume one thing when they see another. And I guess I'd be curious to get your take on like where the different lines are with this stuff, because part of it is, to your point, unless you're truly just doing a narrow banking, we're going to hold your money and we're not going to do anything with it. And literally, whenever you want it, you can have it back, and we're going to make no float and we're going to take no advantage of that. Unless you're doing that, it's some type of maturity transformation. There's risk being taken. The other part to this, though, I think is, how are you describing your product? How are you communicating it to customers? And we see the CFPB jump into those types of problems all the time whenever there's sort of UDAP violations. So how does that figure into your thinking on this?
For sure. So the first draft of this paper that it's before the one I sent you, Kiah, earlier, was focused on that issue, which is these institutions are calling their programs savings. They're calling what they offer deposits. They offer APYs that they compare against banks. These are all banking terms that make people think that they are just as safe as banks. I think this is absolutely a problem. I'm going to leave it to the CFPB to decide in which instances it is unfair, deceptive, or abusive, but the CFPB has brought some cases on this premise.
Yeah.
And I think it's just so important for the CFPB to ensure that customers really understand what they are getting into. Again, we decided to focus on the maturity transformation point in the final paper because we say there is no way to offer this type of activity without needing some kind of regulation. Disclosure is insufficient. But Alex, what you're talking about there with this confusion is absolutely, absolutely a problem. We also know that if these products are intended to be investment vehicles and use the language of investment, they might be subject to the SEC's jurisdiction. They are investment products. And actually,
are they a security?
Yeah.
I remember this coming up. Yeah, I think it was, we all read Matt Levine, I think, at Bloomberg, but like I remember him talking about this with some of these crypto ones where it's like, we're not an investment. And then they describe all the things they're doing. And, regulators are like, oh, so you're a bank. And they're like, no, we're not a bank. We're not a bank. So it's like you really are between a rock and a hard place when trying to sort of market these products if you don't want to be subject to those rules.
So what we say in our paper is that the CFPB needs to be bringing lawsuits under this theory because either they are offering a consumer financial product, in which case they're subject to the CFPB, or they're offering securities and are subject to the SEC. And having the CFPB bring enforcement actions like this under this theory creates some kind of a pincer move to make sure that they are subject to at least some regulation by someone.
Well, okay, so I read this paper before the sad bankruptcy case of Synapse, but when you were actually talking about the crypto bank failures, you mentioned bankruptcy proceedings, you mentioned I had no idea. And, we are seeing actually a lot of similar things coming out of the Synapse bankruptcy. People not realizing that the fintech companies that they banked or that they had money with were not, they felt like they had been misrepresented about what does it mean to have FDIC insurance? What does it mean to have access to my money? I didn't know that, my money had maybe moved into a brokerage account. But this is arguably not maturity transformation as you defined it. That's not really the issue at hand here that feels like the consumer, like why consumers are impacted by this. What we're kind of understanding is that the ledgering, the reconciliation, the use of the FBO account, which I will say, were also issues that came up in these crypto banks, right? So a crypto bank custodies their their USDs at a bank. And there were also some FDIC insurance disclosure issues at some of these crypto bank failures that maybe came up or complicated some aspects of the bankruptcy. So, I'm wondering, as someone who's like not super sympathetic to like anyone's crypto problems, like I actually do now, when I was revisiting this paper, saw actually a lot of parallels and maybe a potential argument to be made that you can't really custody anyone's money if you're not a bank, if you're someone putting money at a bank on the behalf of someone else, as we used to define brokers. You kind of can't also do that without a big risk. And I was surprised, ledgering doesn't even really register as a risk for both things and reconciliation. So Todd, do you agree that there may be some useful parallels between this current fintech consumer bankruptcy case and maybe some of the arguments you were making? And do you see any room for the CFPB here?
Yeah, so I absolutely see room for the CFPB here. Let me take a step back and say, there's a lot we don't know about Synapse's bankruptcy.
Sure.
We don't know the relationship between Synapse and Evolve. We don't know the relationship between the customers of Synapse and Evolve. There's a lot we don't know here. Banking as a service is not exactly what we talk about in the paper, but Kiah, you talked about ledgering is really interesting. And the fact of the matter is that with FDIC pass-through insurance, it is incumbent upon the agent, in this case, I guess Synapse, I would assume Synapse.
Ostensibly Synapse, but sometimes in other arrangements, the fintech, depending on the arrangement.
To keep a ledger of whose assets are what, and if they're not doing that, I think that absolutely is unfair, deceptive, or abusive, especially if they have in their terms of service or contracts a pledge that they're going to do this. Again, I don't want to talk too deeply about what's going on with Synapse because there's still so much that we don't know, but the CFPB absolutely has a role to play in ensuring that firms that are offering financial services to consumers or offering financial services to other financial services firms that offer services to consumers should be looked at by the CFPB. I will say, before we started recording, we talked about how the CFPB is in the free and clear now, thanks to the Supreme Court. They have all the money they need. I think that's really not... They need more money. Like, the CFPB has so much.
I think all the regulators need more money as well.
Everyone listening to this is like, yes, we need more money.
Yeah, but the CFPB has so much ground to cover because there are, frankly, new consumer financial services firms coming out of the woodwork that we didn't really think about before, like Synapse. And it's up to the CFPB to cover all of them. Yeah, so the CFPB, I think, needs to look at this, needs to look at other banking as a service providers, and needs the funding to do it.
So just building on that point, then, one of the things that I am really curious about is this distinction between supervision and other types of sort of regulatory activity that might come in on the back end, right? And as you said, like with Synapse, at the moment on June 20th, we don't know everything. By the time this airs, we might know everything, and there might be a Netflix documentary.
They're going to solve the bankruptcy by when this airs in July.
McWilliams is on it, right? So like they're going to get it fixed, but
they're going to find the $85 million,
right? Yeah, I'm sure they're just like almost there. But one of the things that I think has been really interesting as I've been trying to parse out, with Synapse, where we might have done things differently and who should play sort of a different role is, and Kiah, this is a movie reference coming to a movie you might not have seen, so just prepare yourself. But, in the movie Taken, when Liam Neeson is describing, to his daughter what he used to do for the CIA, and he's like, I was a preventer. I prevented bad things from happening. One of the things I think about a lot with regulatory stuff is whose job is it to supervise proactively these different firms, including all of these sort of consumer shadow banks, and prevent bad things from happening? Because I do think, after bad things happen, there are many different agencies, and the CFPB is usually the front of the line, to come in and police, try to clean up, fine, or otherwise take action against some of these firms. But that doesn't really solve this other issue that we're talking about, which is, how do you make sure proactively that consumers don't lose access to their funds and that they know proactively going in who they should be trusting their money with? And so as it relates to the sort of expanded authority or use of their authority that you're proposing in this paper, how does that kind of relate to supervision versus other types of enforcement mechanisms that we see from the CFPB?
Oh, that is the $80 million question, isn't it? So, Alex, you're a little bit leaning into another paper that I am writing called Understanding Bank Supervision that talks about really what is bank supervision. The CFPB supervises. And the argument I make in the paper is that bank supervision is just regulators using their legal authority to bring enforcement actions and to investigate institutions to find items for enforcement in a really powerful, broad, expansive way because the statutes let them. So let me talk about bank supervision under the 3 banking agencies and then move into the CFPB.
Yeah.
Okay. So the federal banking agencies have this legal authority to prevent banks from engaging in unsafe or sound practices. What is an unsafe or sound practice? It can be a lot of things. Courts have generally said it is banking activities that will pose an unreasonable risk to the financial institution, to its depositors, or to the deposit insurance fund. And so supervision with the federal banking agencies is they send examiners in to look at what's going on. They can provide advice as to the things they find. And if they find things that are really bad or unsafe or unsound, they can initiate enforcement actions. So that kind of is supervision. It's based in what the law says the agencies can do. Okay, so bring this over to the CFPB. The CFPB statute is different from the federal banking agencies. It says that they can supervise particular firms, banks above 10 billion, or larger participants of different markets. They can send examiners in, making sure that consumer financial institutions are acting in ways that are not unfair, deceptive, or abusive. And they can also just identify things they find as issues that the institutions might want to fix. So when we're talking about Synapse here and other consumer financial firms, the CFPB can go in and engage in this type of supervisory activity. But let me tell you, it's expensive to do it. They need to hire examiners to go in. Right. There are thousands, tens of thousands, maybe hundreds of thousands of consumer financial firms around the country that theoretically could be supervised. And so the CFPB does need to pick and choose which it's going to supervise. With the federal banking agencies, the OCC, Fed, and FDIC, statute says that every bank they oversee has to be supervised or has to be examined once a year, at least. The CFPB doesn't have that because there are just too many firms. They just can't. And I think that's something that we need to really wrestle with, that if these firms are holding customer money and there's a chance that customers won't have access to it, do we need to give the CFPB more money or expect the CFPB to do more to ensure that these firms don't fail? Or if they do fail, they fail in a way that customers can get their money out. This isn't something the CFPB can do right now. Like, this has to be something that Congress really wrestles with. And as you know, it's June in an election year. I don't see that happening before at least January of next year, but we'll see.
Yeah.
Alex, did you want to move on to the bank supervision paper? Or did you want me to keep bugging him about CFPB supervision?
We could talk shadow banking for the rest of the podcast, but that is a nice segue actually to the paper that you mentioned and just sort of the, I guess, more conceptual examination of bank supervision. So as you just described kind of how this works, I was really curious. There was a term you used in the paper that I'm wondering if you can elaborate on a little bit, which was a supervisory dance. And the reason that that term I think caught my attention and caught Kiah's attention is that it's a very artful way of describing how these things actually tend to work in practice, as opposed to what you might imagine if you've never been through an exam with one of the prudential regulators, or what you might imagine if you were to just sort of look at the statute and the way that it's described. Obviously, I mean, one thing I always try to come back to with everything relating to banking and fintech is at the end of the day, we're talking about humans working with other humans. And so there is sort of an element to this where there is more art and it's not all just science and sort of sitting down based on the statute and the requirements that we have. So can you kind of elaborate on...
It's vibes, right?
Yeah.
Supervision is like law plus vibes.
Yeah,
right?
exactly. So what does supervisory dance mean?
Okay, so the traditional, or I guess contemporary view of bank supervision is that it is examiners going into banks and telling banks what to do. I see this problem, you have to fix this problem. The expectation is that examiners come in, tell banks to change, banks are going to change. I talk about this supervisory dance where the examiners come in, see a problem, tell banks to change, and the banks need to decide whether or not they're actually going to do it. If they don't, the bank regulator's alternative is to bring a lawsuit so they can say, we're going to sue you to require you to make this change. They could potentially shut the bank down if the unsafe or unsound practice is too egregious. And so bank supervision is this kind of dance between the regulators and the banks where they both need to decide how far they can push the other into making changes or rejecting changes. And going back to Silicon Valley Bank, there have been, in the immediate aftermath, the Wall Street Journal had an article where they interviewed a former SVB bank examiner who said, we went in and we told the bank to fix these things. And the bank brought in their lawyers and said, we don't have to do that. We're not going to do that. And I think this is a perfect example of the dance because SVB realized that it could push back. It could essentially dare the Fed to bring an enforcement action. And the Fed ultimately decided not to push too hard, and we saw the bank fail. So really what I'm saying in this article is we need to recognize that supervision is this push and pull, this dance. And at the end of the day, I think examiners need to start bringing more enforcement actions to actually get banks to change rather than just expecting them to acquiesce.
Well, I feel like I could go either way on this sometimes. That I think, so in 2021, the prudential bank regulators put out what's called the guidance on guidance. And it seemed, if you read in between the lines, and this was a really sensitive article when I wrote about it, like a lot of people really wanted to review quotes, do background, because they just wanted to be really careful about how they were characterizing this. And I was like, come on, what's the big deal? Like the regulators published on it. And I think there was a concern that prior to this guidance being published or rule being published, that examiners would go into a bank and they would say, well, we put out guidance on this. You have to follow the guidance. And they were the guidance was being conflated as law for all intents and purposes in the exam. And it is confusing if you are trying to follow what you think are the rules or the laws. And then you see like, oh, okay, well, they have some tips, they have some advice, but that, we just don't think from our perspective as a bank that applies. So we're not going to follow it, but thank you so much for the input. And then someone comes in and is actually like, you have to do it. And then the power dynamics are such that, if you disagree with your examiner, the polite way to do that, I guess, is to bring in attorneys and get attorneys involved. You can't really hash it out. You can't really debate. Because what are you going to do? Tell your examiner, like, I don't think this is the right move, chief. so they published that rule. And so now examiners maybe are a little more gun shy about saying like, there isn't a law about interest rate risk. However, you are accumulating interest rate risk, and through if a series of bad things happen, it will pose a risk to your safety and soundness. Therefore, something that might be guidance or might be, kind of more vibe-based. I can't point you to a specific thing, but I can tell you that as your risk accumulates in one regard, you are becoming increasingly fragile. And then I don't have enforcement mechanisms to make you make a change. And when I was emailing you about this paper, I was wondering about what's the dynamics between enforcement actions, these like legal, there's the formal enforcement actions, which are the public ones. There's the informal ones, MRAs, MRIs, that are the first three steps before a formal enforcement action, and everything kind of takes time. And then also I was wondering about the role of the CAMELS downgrade. Like, can you say like, as an examiner, hey, I think you're accumulating a lot of risk. It's not a rule, so I can't tell you you're breaking a rule, but I'm just going to downgrade you. And you can just go ahead and say, do you want to carry this, C grade into the next year? And if you want to change it, you can. I'm not saying you got to change it. I'm just saying this is C-level work that you're turning into me. Like, and I'm sure it doesn't 100% act like that, but I've always been fascinated that like, does the troubled bank list mean anything? Right? Like, how the heck did we have 3 banks fail that were not on our troubled bank list, right? If an examiner thinks SVB is like that troubled, if bank regulators won't allow TD to buy a bank over money laundering concerns, and that's not on the troubled bank list, like what does this list even do for us, right? What does the CAMELS rating even do? And how does that fit into the supervision dance,
I'm going to stay away from the troubled bank list, because that is a whole thing right now. But I think it's important to
write a whole paper on it, and then I'll bring you back on and talk about it.
Well, we'll see. I think it's important to recognize what's going on here with this stance, which is the regulators have to enforce the law. And what the law says is banks can't engage in unsafe or unsound practices. What does that mean? Well, I already told you it's something that is overly risky compared to the average bank. There are like actual legal phrasing that courts have used that I just don't have in front of me right now. But it's still relatively broad. And at the end of the day, the regulators, the examiners, need to be enforcing this by going in and identifying things that they think are unsafe or unsound practices. And if the banks want to take the chance that the higher-ups at the agency or the courts will disagree with the examiner, they are welcome to do so. So the examiner can say, we think your available for sale portfolio is in some way unsafe or unsound, and the bank can say, no, we're going to appeal this to your boss. And they can appeal all the way up to either the ombudsman or at the OCC. The FDIC has a SARC something committee. The Fed has its own thing. And they can appeal all this way. And they can basically say, if the bank sues me and says, this is unsafe or unsound, you have to fix it or pay a civil monetary penalty, the bank can then appeal to the federal courts and try to say, hey, courts, this is not actually an unsafe or unsound practice, and we don't need to change. Courts, you can overrule the regulators. That's the way the legal process works. That's the way the process works in actually really every agency across the federal government, not just banking.
Is this an administrative law court?
Yes.
Okay, because that's actually in front of the the Supreme Court. They're actually going to rule on that soon, right? Because they heard a case about that this session.
More, kind of, not really. That's another podcast, or we can go back and forth on Twitter.
Say, that's a totally different podcast.
Yeah. All of these things are just interrelated.
Yes,
so.
Yes, they are. Let me just say, at the end of the day, the regulators can make recommendations or downgrade banks' CAMELS ratings. The bank can fight the enforcement action. They can appeal whatever the regulator decides up to the federal courts. And so that is this dance. Let me just say that I think part of the reason that this is coming to the fore now is the guidance on guidance, which from an administrative law perspective didn't actually change anything. It didn't change the law in any way. It just kind of changed the perception of banks of what they could and couldn't do. And I also think we now have federal courts, especially the Fifth Circuit, that is much more probably out of step with where the Biden administration regulators are right now. And I could absolutely see banks pushing back and saying, we're going to try our hand in court and see if the courts overturn the agencies.
Well, I wanted to double down on that point just for a second, though, and ask you something, which is how much of this, from your observation, I think there's two different ways to interpret it, right? One is to say, each side, regulators and banks, are going to sort of get away with as much as they possibly can. And so, like, if we feel like we can make a good legal argument and this particular court will be sympathetic to that argument, then we have an opportunity to do that and we're going to do it. And it's very much just like transactional in a sense. Like each side is going to try to maximize their own outcomes. That, I think, is contrasted with my impression from 1,000 miles away, so I might be totally off base, around more of the kind of cultural shift that goes into this dance, where you have these periods where banks are maybe just a little more deferential to regulators, just as a matter of course, and that's kind of just the accepted practice and the way that you behave. And then things happen, or that sort of culture shifts, and suddenly it's like, you know what, we don't have to be as deferential, or maybe we shouldn't be, or maybe we feel like our tendency to be deferential is being taken advantage of here. And the reason I mention that is, and Kiah and I have talked about this on previous podcasts as well, but everything around reputational risk would seem to be one of those areas that's maybe changed the culture around how deferential you want to be to regulators, because I think that's an interesting example of really stretching the outer bounds of how we're interpreting risks to safety and soundness. And telling you, like, you know what, we just don't want you to do this. And I could see, I mean, sometimes Kiah and I talk about, regulation as an analogy to refereeing a soccer match.
Oh my God, I've been thinking about refereeing analogies.
I was going to say, I have a tendency to slip into relationship analogies, which Kiah hates, but like,
those are the worst.
I was thinking, like, I mean, part of this is a relationship, right? And it's like, I kind of feel like I'm being taken advantage of.
They're going to come back in a year. You know what I mean? Like, how awkward do you want this to be? They're going to come back.
Right.
Like, you got your charter from them.
This
they
is
can
weird.
pull the charter.
Yeah, exactly. And so it is that dance and that relationship and that culture, I think, is something that I'd just love for you to comment on.
Yeah, no, I think that's absolutely right. And everything is small p politics. Everything is about interpersonal relationships, agency relationships. And one of the things that we've seen the banks do is complain so much about how they are examined by the same people year after year. And so if they appeal an examiner's decision and the examiner is overturned, banks are really fearful that the examiner is going to hold a grudge against them. BPI, the Bank Policy Institute, has written a lot about this. I don't know how sympathetic I am to that, but it's all about relationships. It's all about both sides trying to see what they can do within the confines of the law and the legal system. We have the courts kind of watching over this supervisory dance between the banks and the regulators. And banks can sue anytime they want. The regulators are legally not allowed to retaliate in any way. That is clear, and it's the way it should be. At the same time, that examiners are human, bankers are human, and we need to be very cognizant about the way this works to create the kind of banking system that we as a society want to have.
Well, and Todd, I can't remember. I read this supervision paper a bit ago, but if you're accepting edits from non-academics, I actually think, Fed Governor Michelle Bowman gave a speech in June that talked a little bit about innovation in regulation. And I think that when we think about the trickle of regulation into supervision and what gets regulated or what gets supervised, And then add in this wrinkle of, there's kind of a dearth of regulation that's coming from Congress, and it is creating an interesting vacuum when we think about like innovative activities that involve banks and move outside and beyond banks, right? To bring it back to fintechs. Her speech talks about, quote, where current regulation does not contemplate a new activity should be acceptable for federal agencies to regulate this activity through supervision and enforcement. Or should congressional action address the treatment of these activities in the financial situation? So it is interesting to think about. We've seen like the Federal Reserve's novel bank supervision program form. And I think that that's kind of a useful, they call it horizontal supervision, right? So to look at one activity being done in a bunch of different banks, and then to have a group specialize in understanding that activity, and then being able to compare it against peer banks that is independent of geography and asset size. But what should we think about this supervisory dance when we're kind of on the edge of the supervisory parameter itself? And, how does the lack of clear regulation coming out of Congress, right, the actual, or this the lack of clear rulemaking that is supportable by the laws that the regulators work under, how does that impact examiners, which then will impact banks? And, how would that impact fintechs that want to work with banks, right?
Yeah. So, regardless of the new technology, we have these old statutes that say you can't engage in unsafe or unsound practices. And, just like how I think the crypto industry is always saying that we shouldn't be regulated by a law that was enacted in 1933, I think bank technologists can be saying we shouldn't be regulated by this unsafe or unsound practices framework. But the fact of the matter is, it is. I think the regulators have to walk a fine line between allowing banks to innovate while also ensuring banks are safe and sound and are not likely to fail. We have seen that a lot of banking technology has flowed outside of the banks. I'm not sure why, but it seems like the core processors could have but didn't enact some of the new technologies that the fintech
peeling an onion right there.
Yeah, I know. But we've seen a lot of technology flow from inside the banks to outside to the fintechs, and we're seeing a lot of problems with that because they are unregulated. I think regulators need to strike some kind of balance where they do allow banks to innovate while doing it in a safe and sound way. I'm not sure exactly where that line is. I think it probably depends on the technology, but we've seen that there is a problem. And unless or until Congress does something about the fintechs, it's up to the bank regulators to solve this problem as best they can with the authorities that they have. I'm sure that's not a very nice, clean packaged answer, but it's the one I got.
No, that didn't help.
Yeah. Sadly, there's not a lot of good answers. I mean, I think to your point, it is very much a function of how can we evolve within the framework that we have. And so, Kiah, to your point, I do think, and I've heard this from banks that are engaged in more novel, interesting technology-forward activities, they are starting to really feel the push and pull between sort of regional bank examiners who are familiar with the bank and are familiar with banks in their peer group, but really have no sense of how banking as a service works or AI or crypto. And then the sort of horizontal functions where they're getting informed, oh yeah, you're one of those banks. That means we have this extra set of 200 questions that we want you to answer. And so you are, I think, starting to see very early prototypes of how bank supervisors are trying to kind of get their handle on that. But I feel for them because this stuff moves so fast. I mean, I was thinking about in the context of Synapse and some of the stuff we were talking about earlier with the CFPB, it's really hard, even for someone who, studies this stuff every week. I don't know that I could give the CFPB like a prioritized list of make sure you go in here, make sure you go in here, like deciding where to focus given how fast and how diverse fintech is. It's a huge challenge.
I also want to say that, Todd, I don't know if you've noticed on Twitter, we're trying to run an influence campaign around the BSCA and think about the powers and authorities that the Bank Services Company Act which was written in the 60s for a very specific type of banking
I have,
industry.
and I love it.
Okay.
We'll get you a t-shirt. We're making t-shirts, so we'll get you one.
And it is interesting to think that like when we think about the laws that we have to work with today and how have those laws been applied and interpreted, how has, and someone explained to me like the BSCA is about offering services to a bank, not services through a bank. So, thinking about, and so when we think about the role that the core providers, right, we know that the core providers can be regulated, are subject to the BSCA because they provide the services to the bank itself, even if sometimes those services flow to the end customer. And then it's just like, well, yeah, but like the law exists. Can we interpret it in a different way? And I was thinking the whole time we were talking about supervision as a referee, right? Like, the way I'm assigned is they don't want certain teams. They want to limit how many times a referee sees a team, right? They do not actually want familiarity. It is best for everyone if there's a little bit of like unfamiliarity and then, they think about how do we train soccer referees? The thing that they tell us is to always cite the laws, right? Whenever you make a decision and someone questions that decision, it's safest to cite the laws and the considerations that go into our laws rather than your own interpretation. And then the other thing too is like, sometimes it's like you're trying to manage behavior and rather than like be like, to say like, someone will say, I didn't think that was a foul. And then I'll say, okay, do it again then. And they'll be like, well, you're going to call it. And I was like, I guess it's a foul. Like, I don't know what to tell you. Like, if you don't think something's wrong, I'm not going to tell you not to do it. I'm just responding to, what you do. So that's kind of that like supervision dynamic. But to think like, in what ways have we kind of underestimated the powers of the BSCA? And is there room for different interpretations from the prudential bank regulators? Or does the CFPB need its own BSCA type thing? Or can they just actually use their powers and go after things that would have impact, right?
Yeah, I mean, I'm not a BSCA expert. I am learning just as much as
get on this train, man.
All.
We got it. We're getting people.
I will say that, my understanding of the way things are is that regulators can supervise bank services companies, but the only kinds of regulations they can do are on banks' interactions with third-party service providers. And so that's why we've seen all of the third-party service provider guidance from the banking agencies, because they need to tell banks or what they can and can't do vis-a-vis third parties. Because if something goes wrong, the only recourse the regulators have is to say, hey, bank, you failed to properly oversee your interactions with a third-party service provider. That's an unsafe or unsound practice. And so I think, again, I'm learning just as well as you guys are, but I think this is something that Congress...
We're all learning about this law.
Yeah, Congress needs to... It seems like it's something that could use a real update from Congress and a real hard look at by Congress.
We could just have like a pre-recorded soundbite that we could run in this podcast where we push a button and it says, hey, Congress, could you please help us out with this? That would be amazing. And we'd hit that button a lot on
all
this
the
podcast.
Time.
It sounds like Bowman agrees with us, though. Yeah.
Yeah, I mean, we have at least some support. All right, so to wrap up, before we let Todd go, Todd, if you have listened to this podcast before, I always try to give Kiah an opportunity to rant quickly about something at the end, because she always has something she wants to go off about. And I think, Kiah, your topic for today is very relevant to everything we've been discussing. So go off, Kiah.
Yeah, so we've been talking a lot about the CFPB and the powers of the CFPB and what the CFPB does on a day-to-day basis. And something that I've always been a little confounded by is the CFPB's to-do list, is how I'll phrase it. I think they have picked some strange fights, and I think they add a lot of stuff to their to-do list without ever seeming to take anything off. And so there have been times, especially this year, where, I think I have thought that there are situations where the CFPB could just chime in real quick on something, kind of like I think with Solo Funds. There's been an outage for 2 months where Solo Funds is a lender and they are debiting customers' accounts without giving them access to the loans that they've taken out. And, I've been curious, I think that the CFPB, like I said, does have a role to play in the Synapse Bankruptcy or in the supervision of other banking-as-a-service middleware providers, given what we have seen from Synapse. Thinking like seeing these in the market or seeing these in the economy, and then hearing that the CFPB has decided to look at Apple's digital wallet, of which I literally I kind of can't even figure out what the problem would be. And it just kind of seems like a way to get into Apple through payments, which Todd, I'm sure this is in your maturity transformation paper. But I just kind of don't get where the CFPB decides to dedicate attention and what it sees as a problem and what it sees as abusive consumer harm, and then what's actually happening in the market. And I kind of think the video games thing was a little dumb. I'm not saying there's a lot of money, and there's a lot of money, real money going to video game fake currency. And that's, I guess, something the CFPB worries about, the ability to dark patterns on them, or kids using their parents' cards and stuff. And I get it, but I don't know. I just don't know if I think that's where I would spend my time. And then separately, open banking and small business data collection, these are really, really big tasks. And the CFPB is doing both of them at the same time. And I just kind of wonder, if you do too many things, you're kind of doing nothing, right?
Todd, we should give them more money, right? That's the answer. What's your response to Kiah's rant?
Do fewer things, hire more people. I don't know.
I am not touching Kiah's rant with a 10-foot pole, but I am always in favor of giving the CFPB more money.
There's too many things. There's too many things on the to-do list. You got to prioritize.
The only other thing I'll add to it just really quickly is it is interesting to watch what the CFPB chooses to prioritize and try to
mystify
that. The pattern I'm trying to connect it to is, and Kiah, you'll understand this being a referee, but do you ever referee a soccer game where you see a certain player go onto a part of the field that's not really their part of the field, and the interpretation of it is, oh, that person doesn't trust their teammate to do their job over there. And when I see the CFPB do certain things or not do certain things, I kind of can't help but think them thinking oh, the SEC's got that. We don't need to worry about them. They're doing their job.
Stay in the lane.
Yeah, we'll stay in our lane. But then I think they see other areas where they're we can't trust so-and-so to do this. We have to jump in here. And so I do wonder a lot about the stay in your lane dynamic as it relates, particularly to the CFPB, because they have a pretty wide remit to jump into other people's lanes if they want to. So it is always fascinating to watch.
It's just been so interesting for me with Synapse to say, when people are where is the FDIC? And then to say, this is not, it kind of involves the bank, but the bank is not the one that's in big trouble. And people for people to be we want a regulator in here. And Todd, we didn't even touch the federal state banking agencies that do actually have supervision authority and can access or can issue charters to these companies. And arguably many non-banks involved in money transmission should be carrying these licenses. But I just am I'm so fascinated that I think Solo Funds was out of operations for 2 months before the CFPB issued something. And I just what's the delay? That's 60 work days, right? Can you just send a letter, a strongly worded letter that's hey, if you can't give people access to their funds, stop debiting the accounts, or we expect you to refund in, a week if people cannot get access to their funds, and just cancel the loan, right? Cancel the loan, reissue the refunds. It just seems like such a gimme. And so for the CFPB to wait for some reason until you took 2 loan payments out of people's accounts, that seems abusive. That seems like a gimme. So that's my rant.
Well, that is a marvelous rant. Todd, thank you so much for joining us. Thank you for humoring our dumb questions. We are a huge fan of the papers you write and the work that you do. When you write some more ones that trigger Kiah, we'll bring you back on for another therapy session where we can work through some of these issues. But we really enjoyed it. Thank you so much for taking the time.
Yeah, thank you for having me. This was a blast. And it was great. Thanks so much.
Thank you. Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.